Today's episode of the Daily Recap Show is brought to you by Jerome Powell.
President Biden, do you want me to keep hiking into the election?
Now, the way these videos usually work is I talk about market things and then the market does those things. You make some money, I get some views, and Bob's your uncle. And I don't see why we have to rock the boat. We got a good thing going here. So let's get to the part where I say some things. Welcome everybody to the Daily Recap Show where we talk about stocks in the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very, very ugly day, except in Meta. Meta was up 4% after its earnings. That was the only green in any of these cyclical sectors. It was red in tech, financials, industrials, discretionary, everywhere was red. And then you look at the heat map, where did we see green? Healthcare, real estate, utilities, consumer defensive, or consumer staples. The market is getting defensive. There is something the market is seeing under the hood that they're not liking, and I think I know why. It has to do with the economic data we got and the FOMC yesterday. I think the market's getting a bit worried that maybe the Fed waited a bit too long to cut rates. I think that's the price action we saw, and we saw a flight to defensives. Utilities leading the charge, up 1.8%. Same here with real estate, 1.5%. While not necessarily a defensive sector, it does have defensive qualities that investors like to go to during turmoil, especially with the rate cuts on the horizon. Real estate in the environment we're in right now is a defensive sector. Healthcare was up 1%, consumer staples up 1% as well. And then communication services up 0.4%, but it wasn't just Meta that boosted this. You have to have a look at the composition of communication services. If we go back to the heat map, you see telecom services right here. These are actually considered defensive stocks, very similar to the way that utilities and consumer staples are considered defensive stocks. And that's why they were very green today in the context of all of this, and they did help communication services. So sometimes when you do see comm services bid up during market pullbacks, it actually has to do with telecom services. They're buying the telecoms in that sector. But technology has been whipsawing investors over the last couple of weeks, down 3.7% today. Extremely volatile, and that's what you get when valuations are extremely stretched. Earnings season, FOMC, rate cuts on the table. When you get the mix of all of this, you get the price action you see in technology. Energy was down 2.7% as well. Same with discretionary, industrials, financials. Anything that was cyclical and tied to the economy really did suffer today, and we just bought defensive stocks. I mean, you have to pay a power bill and you have to buy toothpaste. That's why these stocks were up here today. But it wasn't just large cap. Small caps suffered the worst, down 3.1% in small growth, small core, small value, and then mid caps, and then large growth. In fact, we actually saw large value down 0.7%, you know, like this right here, large value. These are the defensive sectors. This is utilities, real estate, energies in there as well. And yeah, what we really saw was a bit of a move out of smalls and into this component right here, into large cap value. But the session didn't start out red. Here at the start of the day, these sectors were very, very positive. Let's exclude TLT for now, so don't mind the red one. These sectors were very, very positive. At one point, Nasdaq 100 and the S&P 500 was up nearly 1%. Even the Russell right here was in the green. Then we got some of the weaker manufacturing data, and then things started to go sideways, and it had to do with economic data. Weak data raised worries that the Federal Reserve may have missed its window to cut interest rates before undercutting the economy's growth. When you look at stuff like continuing claims, initial jobless claims, they missed right here. And we do know that the consumer is softening. In the macro portion of the video, we talk about that. There's some very worrying warning signs we have to pay attention to. And if the labor market cracks, this thing is going down. And this is what the market is getting worried about. Interest rates were raised to soften the economy, tamper inflation. Did the Fed do too much? And that was the sentiment behind the price action. Also, when you look at stuff like the ISM manufacturing numbers, they were horrendous. Expectations were 49, came in at 43.4. That's a contraction where the previous was 49.3. So we're seeing manufacturing activity move down. And then you actually have a look at something like prices paid. Prices paid increased more than expectations. So manufacturing activity is contracting and you have to pay more for that contraction because prices paid was 52.9. That's concerning, especially when prices paid was 51.8. That's going to hurt the manufacturing sector. That's going to hurt the economy. And that's why we saw the price action we did today in yields. From the shorter end, the 2-year yield, all the way to the 30-year yield, yields fell anywhere from 0.65 to up to 2.5% after the economic data and the price action we saw today. In the context of everything, commodities were rather tame. Gold was flat on the day. Silver actually fell 1.69%. The $28 support now turning into resistance. And crude actually fell as well, down 2.05%. It was very clear the price action we saw. And it was very easy to see the price action today. Commodities got sold off today. Equities got sold off today. Bonds caught a bid. And the DXY was firm. Along with rotating into defensive equities, we were literally just moving into cash and or bonds because the market's getting worried about growth concerns. And that's why we saw the dollar, the DXY was up 0.31% today. When the dollar firms up, that means people are going to cash, people are going to bonds. TLT actually breaking above this 94 area. It's a key area we looked at, and this literally now opens up 98 and even $100 to the upside, as long as this 94 area right here is used as resistance in the future, and then we move up. So very constructive price action in bonds, but it's coming at the expense of potentially weaker economic growth and cracks we're seeing in the economy. But we have to see if this plays out. I mean, tomorrow we get non-farm payrolls. Non-farms can literally beat tomorrow, and then Bob's your uncle, we rip higher. Now looking at the S&P 500, these are the gamma zones. So this yellow line is the gamma flip. This is the put support. This is the call resistance here at 5750. The put support now at 5300. It's been moving between 54, 5300 up and down. There's two big strikes there between right here and right here. But what we saw is we had a little bit of price action here in positive gamma, but we couldn't actually go ahead and take some of these key levels in the S&P 500 right here. If we just zoom in a little bit, we couldn't like capture these levels right here, even on a daily basis. Then the bears came in, and the second we got below the gamma flip zone, we actually saw intense negative gamma activity. If we hop on the 5-minute chart, we had this gap up right here. We're in positive gamma. Then the market started getting worried. At the second we broke this line right here, it was just dealers selling into the weakness. And then we had the degenerate bears take some profits right here. And this is why we saw this mild up move at the end of the day, all the way back to the 5450 zone. But very negative gamma heavy price action. And our target right now is the 5300 as long as we're in negative gamma. You can see that we did put in buyers did come in at these lows right here, but I do think that it was just the 0 TTE hedges rolling off and not any like firm buyers in the market. But we're going to have to see how this plays out. One thing to note is that we are officially out of the window of weakness, which means if we stay in negative gamma, dealers are certainly hedging with the trend, which means if we go up, dealers are buying. If the S&P 500 goes down, dealers are selling. So it's really key right now in negative gamma to be cognizant of the levels where you're placing trades. This is especially if you're a day trader. If you're a longer term investor, I would really look at where the put support is positioning in itself and then taking positions at those levels. And right now, that is the 5300 area. If we, let's say, get an inline non-farms, maybe a bad non-farms, the sell-off continues. The first level we want to be buyers at is the 5300. If we then go ahead to this level, find support, move up, Bob's your uncle. If we then come down, break this level, use it as resistance, then we'll talk about where the S&P 500 goes next. We're not there yet, and right now our downside target is 5300. We only look to the 5700 area once we break this gamma flip. So a lot of price action, a lot of trade happening right here. The market is consolidating in the S&P 500, in the Nasdaq 100, just digesting all of the gains we've had this year. It has been a stellar run, and a bit of digestion is actually really, really healthy. The problem is that this digestion right now is coming at times when the economic data is not looking too frothy and people are conflating one thing with the other. With regards to the IWM, I mean, as long as we hold this level right here, this 217 level, I remain constructive for all-time highs. Bulls really need to hold this level right here. You can see they did today. There was definitely some buying. If you missed a rally, this is probably where you want to get in small caps, but they need to hold, because if we break below and we start drifting below this 210, 212 area, we're back into this balance zone, and then you can kiss this tailwind goodbye. So a lot is going to be dependent on the non-farm print tomorrow. Guys, what we really want to look for is 175. 175 Anything above that going to be really good. It's going to shake off growth concerns. Anything below the 175 mark, that's a bit concerning, and especially with the ADP numbers we got. We talk about it in the macro portion of the video. Jump to the macro portion of this video. We talk about what we saw with ADP and how that might affect non-farms. Things not looking good for the economy, things not looking good for the labor market, especially if the numbers come in weak. But both do expect a better than expected non-farm print. A lot's going to be dependent on that non-farms, guys. So that's something you definitely want to watch tomorrow. It's a very important non-farm print. Now guys, let's talk about sentiment. This is the AA sentiment survey, and something we look at every single week, guys. And you need bulls for a bull market, and we have bull sentiment ticking ever so slightly up. But the even bigger story is that we saw a huge down move here in the bulls. It doesn't look like much, from 31.7 to 25%. That's actually like a 20% reduction in bearish sentiment votes. We saw an uptick here in neutral votes, and it's very easy to understand what happened. Those that were bearish moved into the neutral camp, and those that were bullish continued to remain bullish. And we continue to see elevated bullish sentiment, subdued bearish sentiment. In fact, the averages for both of these, the average sentiment is about 37%, and you can see well under here in bearish sentiment, well over in bullish sentiment. And sentiment remained elevated throughout July, despite the big boys, the Nasdaq 100, actually falling 3.23%, and on a peak to trough basis, it was actually down 9%. But sentiment remained bullish because we actually saw a rotation in the month of July from these bigger names into the rest of the market, particularly small caps. The Russell 2000 up double digits in the month of July, 10.45%. The equal weight was the second best performer, up 4.46%. We actually saw a bid here in global stocks. Long duration Treasury saw a bit up. What we really saw was just a little bit of rotation from the big names, the Magnificent Seven, Apple, Nvidia, Google, Meta, into literally everything else, particularly small caps. But the truth is, it doesn't take a lot to move the Russell 2000. But that is the month of July. What comes next? And if we have a look at seasonality, we can see that the average performance for August from 1950 to 2023 is actually relatively flat. We can see some violent upside, we can see some violent downside. Net, we normally finish just shy of the 0% mark. And so August is the month where things really begin to turn. In years when we've actually had a positive May to July, August is normally negative, with an average return of negative 0.057%, median change of 0.65%, 20 wins, 26 losses, and horrendous hit rate. And that's what we did here in 2024. From May to July, we actually had a very positive year. Maybe not quite that positive. These stats are as of the 20th of July, but we were positive in this time period right here. And this lends itself to August being a down month, along with seasonality since 1950, seeing August returns being relatively flat. But regardless of price action, what we really want to look at in the year now is earnings. Earnings surprise factor for the S&P 500 is at 4.2%, and in fact, if you actually just remove the discretionary space, this number jumps to 6.2%. So this overall surprise factor being held back by consumer discretionary. Nonetheless, we're seeing surprises in every single S&P 500 sector, the best being materials, healthcare, and energy, albeit coming off a lower base. Even those that are coming off a strong base, stuff like technology, comm services, seeing surprises of 2.3, 2.8% respectively. And that sentiment was not reverberated in today's earnings reports. Moderna was down like 20%, absolutely crazy price action. Not on this list is Snapchat. They were down 20% as well, I believe. They missed on both the revenue and the earnings side. Bookings Holdings reported their earnings. There was some respite here. They were actually flat in the after hours. They reported an EPS beat, a sales beat, but a lot was priced in. Intel is one of those dumpster fires here today. They slashed their dividend, cutting 15% of their employees. They missed on EPS. They missed on sales. It was a double miss. Absolutely horrendous earnings. They were down 14% in the after hours after that report. Atlassian, this is actually an Australian company that trades in the US. They actually reported an EPS beat. Sales came in line. The stock was down 16% at one point, 11% here so far in the after hours. Crazy price action. Coinbase was another big name that reported. They were up 1% in after hours. They reported a sales beat and EPS in line exactly with expectations at 14%. And then we had Amazon. Amazon was down 6%. They had a huge beat on EPS, but they missed on the revenue side Market did not like that. You can't be missing on revenue. And of course, we had the biggest stock in the world, Apple, report its earnings, probably the one you all want to know about. And Apple actually reported a double beat. They beat on EPS, $1.40 against $1.35. They beat on sales on 85.8 billion, and Q3 iPhone sales actually came in below expectations, but slightly below. They missed by about $300 million when they do about $39 billion in iPhone sales for the quarter, which is nuts. Apple were pretty much flat here in the after hours. At one point, they were nearly up 2%. So definitely some positive sentiment here in Apple, but the rest of the market looking real dicey here on this Thursday. Now let's look at fund flows. This is buybacks as a percentage of S&P 500 market cap. And for the 20th straight week in a row, BOFA's private client buybacks are actually above the historical average, guys. And this is as a percentage of market cap. And this actually includes a buyback blackout period. That's probably part of the reason why we saw a bit of a dip in this July period with regards to the Nasdaq 100, the mega cap names. However, buybacks should follow suit, and corporate America is showing investors the money, and that's keeping a bid underneath the stock market. But buybacks don't tell us the whole story of fund flows. BOFA's private clients last week, this date right here, actually saw buying in comm services, discretionary, and healthcare, and they mostly sold technology, and there's no real discernible trend to take away from this. All you can say is that in total, what we saw over the last week was net buying, and that was also true for the 4-week average. So let's talk a bit about the macro. So yesterday we got the ADP employment data, and the consensus expectations was 168. We came in at 122,000, and there's just no way to put this. It was a bad number. It was a bad print. Do take it with a grain of salt, because ADP is actually losing significant market share to pretty much all of the other competitors, one of them being Paycom. I'm invested in them, and Paycom is handily taking market share from ADP. So take these numbers with a grain of salt. Nonetheless, still terrible consensus expectations, and we need to pay attention to the labor market, because if the labor market cracks, things go sideways very, very quickly, especially as we are seeing delinquencies rise. This is delinquencies on all loans and leases for all commercial banks. So it's probably the healthiest measure you need to look at when it comes to delinquencies. It's not selective data. It's across the entire broad spectrum of the US economy, and there's no two ways about it. Since 2023, delinquencies have been on the up and up, and along with delinquencies rising, what we've actually seen is consumer spending, retail sales being very, very healthy between the 2 to 3% mark. This normally tracks GDP very closely, and to see retail sales above 2.5, 2.6, 2.8% here in this quarter, 3.5, 3.6%, this is telling us something very, very obvious, right? Delinquencies rising while consumer spending is still robust. What does that tell us? It means that consumers are just putting a lot of purchases on credit, and they can't afford that credit. That's literally what this data is telling us. And that's why this upcoming NFP print is a big one, because it determines if the Fed needs to cut to save the labor market or cut to normalize policy. And non-farms are likely to come in at about 185,000. That's the Reuters poll. I've seen consensus at about 177. BOFA reckon non-farms is actually going to come in at 225,000. What I can say about this is if we do get below the 175 consensus region, if we actually get below that level right there, it's going to do two things. It's going to definitely give the Fed the fuel to cut, but then we need to start looking at, okay, what's going on in the economy? Why is this softening? And is this just a 1 month thing, or is this something more serious happening in the broader economy that's going to continue? And I think the market is going to grapple to price that in. So pray for anything above 175. Anything below, things will get shaky. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm